There's this one single number that has the power to pretty much make or break your entire financial future. It's not your salary, it's not what the stock market is doing, nope. It's a number that quietly shapes your entire world. And today, we're going to pull back the curtain on it.
So, what is it? What single number has that much control over your savings, your mortgage, even the price of your food shop? That number is the interest rate.
All right, so let's get right into it. What is an interest rate, really? Let's break it down to the basics.
Okay, the easiest way to think about it is like this. Let's say you lend your mate a tenner. You might say, hey, give me an extra quid back when you pay me next week, right? Well, that extra quid, that's interest. It's the cost of borrowing money, but it's also the reward for saving it. Two sides of the same coin.
So where do these numbers even come from? Well, they aren't just random. Here in the UK, the big decision maker is the Bank of England. They're the ones who set what's called the base rate. Think of it as the main foundational interest rate for the whole country. And from there, all the other banks, your high street bank, they take that base rate and set their own rates around it.
Okay, enough theory. Let's talk about how this actually hits you, right where it counts, in your wallet. Because really, it all boils down to two big decisions you make with your money. Do you save it or do you borrow?
Look, when it comes to savings, the logic is super straightforward. If interest rates are high, suddenly your savings account is actually working for you. That 2% return might jump to 4%. And suddenly you're thinking, maybe I won't buy that new telly after all. I'll save instead. But when rates are low, the reward for stashing your cash is almost nothing. You're much more likely to think, well, I might as well spend it.
And then there's the other side of it, borrowing. When rates are high, getting a loan feels, painful. That mortgage or car loan suddenly has much bigger monthly payments. It's a real deterrent. But when rates are low, it's almost like the banks are rolling out the red carpet. Borrowing is cheap, and those big purchases, a house, a new car, suddenly seem a lot more achievable.
Now, you might be thinking, my little savings account isn't going to change anything. But here's the thing. When you and your neighbor and millions of other people all start making the same choice at the same time, it's not a small ripple. It becomes a massive wave that can shift the direction of the entire UK economy.
And it's not just about us. Look at what happens to businesses. It's a total chain reaction. Let's say interest rates go up. Well, that means the cost of borrowing for companies also goes up. So that big plan to build a new factory and hire a bunch of people, the loan for it just got way more expensive. And all of a sudden, the project might not be profitable anymore, and boom, it gets canceled. And those ripples just keep spreading. Back at home, higher rates mean your mortgage payment probably just went up. You've got less money in your pocket, so you spend less. But it even affects things on a global scale. Think about it. High rates in the UK look really attractive to foreign investors. They want to put their money here to get a better return, right? That increases demand for the pound, which makes our currency stronger. And, you guessed it, low rates do the complete opposite.
So this leads to a really important point. Interest rates aren't just some random number that floats around. No way. They are the Bank of England's #1 tool, their main lever that they pull on purpose to steer the economy. Honestly, the best analogy I've ever heard is this one. Interest rates are basically the gas and brake pedals for the economy. Is the economy looking a bit slow, a bit sluggish? You hit the gas. You lower the rates to get things moving again. Is everything getting a bit too hot with prices rising like crazy? You gently tap the brakes, raise the rates to cool things down.
And we've all just lived through a perfect example of this, haven't we? It's been a wild ride. Think back to 2020. The economy was at a standstill. So, what did the Bank of England do? They slammed their foot on the gas, cutting rates to almost zero. But then, a couple years later, inflation was soaring, so they did the opposite. They slammed on the brakes, hiking rates up to over 5% to try and get things under control.
So why are they always messing with these pedals? What's the end game? Well, it all comes down to one magic number. 2%. That's the UK's target for inflation. It's kind of like the Goldilocks zone. Not too hot, not too cold, just right. And their main job is to hit that 2% target, using interest rates as their #1 tool to do it.
Okay, so we've covered a lot. If you're going to remember just one thing from all of this, what should it be? Let's boil it all down.
It really is this simple. High interest rates, that's great for saving, terrible for borrowing. And that slows the economy down. Low interest rates, awful for saving, but great for borrowing. And that boosts the economy. That's it. That's the fundamental push and pull.
So yeah, interest rates are this powerful tool for keeping things stable. But we can't forget, every time that rate changes, someone wins and someone loses. High rates are fantastic for retirees living off their savings, but they're a total nightmare for a young family trying to get a mortgage. It's always a balancing act. And it leaves you with a pretty big question, doesn't it? When these big decisions are made, who really wins?